some of those infrastructure prices getting pummeled recently, particularly in the transport infrastructure space. Look, I think that the fear here is the market's actually moving ahead of that Fed funds rate decision. So some of the number crunching I've done is that historically, if you've seen an upward tick in the US short end of the curve, typically it drives the long end upwards. And just on my number crunching, there's about an 88% correlation between the US 10-year bond rate and our 10-year bond rate. So if theirs goes up, ours moves up. Now, we've already started to see that already. So those that have been following it, you would have seen that our 10-year bond rate here is ticked up a bit over 20 basis points. So we're now back over 2%. So the direction of the interest rate movements has changed, at least in the short term. And we're starting to see that feed through, or have seen that feed through in the transport infrastructure stocks in particular. Now that makes sense to me. So first up, the transport infrastructure stocks ran incredibly hard since the start of the year. So there's been profit taking there. Secondly is that the energy infrastructure stocks have the ability to pass higher interest rates on at their next regulatory resets through the higher regulated WACC allowance. The transport infrastructure stocks don't get that benefit coming through in their revenue stream. So when interest rates are falling, that benefits transport infrastructure, and when it's rising, it goes the opposite way. So just something to watch out for there. Look, in terms of the reporting season, there was no nasty red flags that emerged. Maybe a little bit of additional cost coming through on Transurban. There was a bit of a cost surprise on Sydney Airport, but when I actually looked into that, it just made sense. It was the timing of a step up in costs they'd guided for. When you dig into the business models, those stable and predictable cash flows are still there. The growing distributions are still there. The CPI linkage in their revenues are still there. And I think it's worth pointing out there when Michael's talking about that sort of 4% inflation discussion, that's actually a good thing for the sector. If you hear the major infrastructure fund managers out there, they talk about how infrastructure is a quasi-inflation hedge. And that's because the revenue streams are actually linked to CPI, either through the price increases or regulatory resets. And what else have we got there? Also very solid balance sheets. We've got the Transurbans at BBB+, the Sydney Airport, BBB at the moment, potentially could go up to BBB+, APAs, etc. at BBB. So very solid balance sheets. So underlying businesses are still travelling very well. We've just seen share prices come off, particularly in transport, infrastructure. And to me, that means that value has actually emerged. And let me just take you through some of our preferences and what we're looking for there. So first up, Sydney Airport, ad rating, $7.85 target price. Share price closed yesterday at $6.54. If I'm looking at the next 12 months in terms of their distributions, it's now yielding about 5%, double-digit distribution growth. How's that getting driven? International traffic growth is travelling at well above historical trend levels. We have development of commercial activities and lower interest costs are driving free cash flow at sort of a high single to low double-digit growth rate. Worth noting, management is incentivized to grow cash flow at 8 to 12% over the next 3 years. So they pay out virtually all of their free cash flow as a distribution. So you can get a good sort of beat on where they think things are going to grow on that front. Holding an investor day on the 17th of October. So that's often a catalyst for the stock. And the big thing we're waiting out there is Badgerys Creek, the second airport in Sydney. The timing on that just seems to keep on slipping, so just waiting for that event. MQA, ad rating, $5.86 target price, close $5.07. Look, it's only yielding about 3.7% at the moment, but I'm expecting a very big step up in 2019. It's close to a doubling in the distribution, and I've talked about the drivers for that in my research notes. The short-term catalyst there is that their 50% co-investor in the Dulles Greenway is looking to exit their investment in that asset. So MQA has said they will either be a buyer or seller in that transaction. So just keep a lookout for that one. That should be, I think, a late fourth quarter or early first quarter next year type event. Transurban, $12 target price, closed yesterday $10.79. So it's really come off. It hit a high of, I think it was $12.70 or $12.80 before it's come off. Yield 5%, TSR 16%. double-digit growth in distribution coming through, just like Sydney Airport. The management there are incentivised to grow their free cash flow at a high single to low double-digit, 8 to 11% per annum type growth. Big bang project there is the Western Distributor project. Very significant amount of capital that look to invest in that project, looking to hit financial close on that in the middle of next year. Now, my target price for Transurban is probably a bit more stretched than what I've got for the other infrastructure stocks. I have factored in that Western Distributor project coming through. I think it certainly has the political drive behind it now for it to be complete. And I've got lower discount rates than other stocks to get to that $12 target price. It wasn't all that long ago I felt like the share price had well and truly sort of overtaken me on that $12 target price. Now it's come back. I do actually check my target against others in the sector, other analysts, and I'm certainly not at the top of the pack. I'm probably more towards the bottom end. So just an interesting one to point out there. In the energy infrastructure space, look, there's really not as much value that's emerged, and the logic to that is really the share prices haven't fallen nearly as much. I want to highlight that I initiated a reduced rating on DUET in the reporting season. The logic there is that I see medium-term cash flow headwinds for that business, which means that the current level of distribution I don't think is sustainable. And secondly, I think the market has really just got the value of the Dampier-to-Bunbury pipeline wrong. So I see a share price target well below that, $2.14. So sort of I think it's about -4% type negative TSR on that stock. Look, sitting outside of those infrastructure stocks, those high quality infrastructure stocks, I just wanted to point out two other names that sort of stood out to me. First up is Cleanaway Waste Management, the old Trans-Pacific. That was a bit of a surprise packet for me during reporting season. So new CEO in there, for those interested, has a ex-Berkshire Hathaway background to him. He has basically started to really get the cost out going in that business. They're getting a reasonable amount of, just a low level amount of revenue coming through. So on a cost base where you've got costs coming out and a little bit of revenue growth coming through, capital intensity has been reduced, so they're really controlling the capital. And they've got a balance sheet which is well under geared. It looks like an attractive little stock to me. $1.13 target. Had up that target from 77 cents during reporting season. It's pulled back a little bit. It's about $1.08 now. As it gets towards $1, or if it gets down towards there, I'll be looking to pick that one up. I think there's more to come from that one over time. The last one that stands out to me is Qube Logistics. The existing business, very cyclically exposed, so it's been a bit weak over the last year, but management thinks that the earnings there have bottomed. They've just bought the Patrick's Container Terminals business, and that is a business that the Qube management team knows incredibly well. They helped to develop that when they were at the Patrick's group. And the absolute jewel in the crown is the Moorebank project. For those who don't know about it, I mean, that Moorebank project is likely to be the third most important freight logistics precinct in Sydney, behind the airport and the port, by the middle of the next decade. So a longer dated growth project there, but incredibly valuable. $2.58 target price, closed at $2.33. Yield isn't a big part of this story, but the TSR is about 13%. So happy to be chipping away at that stock at these sorts of prices. I have had some advisors sort of ring me up to talk about what's happening in the sector. My suggestion there is potentially start to buy some of these stocks now, but keep a bit of powder dry just to see what happens with that Fed funds rate decision coming through September 21st.